All right. Hi, everybody. Our topic today is free cash flows to the firm. Depending on what textbook you're looking at, you'll also sometimes see this called cash flow from assets, but the more common label for this topic is free cash flows to the firm. I want to try to set the stage or give us some context by giving you just a few reminders of things that we've talked about previously. First off, I want to remind you of this thing that some people call the virtuous cycle, right? This idea that a company or even a group of people that have a great idea, one of the first steps is they need to get some capital. So the beginning of sort of this virtuous cycle is that financiers provide capital. Once an organization has capital, typically they use that capital to procure assets. Those assets then are teamed up with labor usually, and the assets and the labor produce a good or a service. That good or the service is then sold, and so it generates revenue. Hopefully the organization understands how to manage its expenses. If the organization can manage its expenses, then that revenue can translate into net income. Now, once you have net income, that's going to go one of two places. And by the way, I'm being a little bit loose here in the sense that I'm imagining that cash flows are kind of equating to net income. That's not always the case, especially in the short run. But once you have net income, and let's assume that that sort of represents excess cash, then what you can do with that cash is you can either plow it back in the firm by procuring more assets. So we'll just call that plowback. Whatever money, whatever profit doesn't get plowed back into the firm, whatever doesn't get retained, right? That's another label for this is retained earnings. So whatever doesn't get retained or plowed back, that's going to be distributed back to the financiers. That little red box right there is going to become important as we move forward. But this virtuous cycle, and by the way, when the excess income then gets distributed to the financiers, then the cycle can start all over again, right? Because now those financiers have fresh capital that they can invest in new companies or new ideas or new projects. This virtuous cycle is also a really helpful lens through which to analyze sort of the broader discipline of finance. Remember, we said previously that definitionally finance is a subdiscipline of economics, and we can broadly define economics as the study of the optimal allocation of scarce resources. Maybe that's too narrow. Maybe we could just call economics the study of the allocation of scarce resources. If the resources aren't scarce, it's not very interesting to study. But I would also argue that the reason that we study various ways of allocating scarce resources is because we want to find an optimal way to do it. So for me, economics is the study of the optimal allocation of scarce resources. Finance is a subdiscipline underneath that broad heading of economics. So when we think about finance, we should be thinking about the study of the optimal allocation of scarce financial resources. So we're primarily talking about capital in finance. But again, really what it's about is the study of the optimal allocation of scarce financial resources. We generally think about three categories underneath the heading of finance when it comes to optimal allocation of scarce resources. And I've tried to sort of color code this a little bit so that this virtuous cycle can be a helpful lens to help us understand these three subcategories of finance. So there's a procurement phase when it comes to the optimal allocation of scarce resources. So that's both financiers making that initial decision about where they will allocate their capital. That's companies and organizations thinking about how they can attract capital, debt, equity, how to structure that, whatnot. So that's sort of the first component of finance. The first component of optimally allocating scarce resources is just the procurement phase. Then one of the bigger phases, and the one that we're really going to focus on as we spend time together, is what I call the deployment phase. And the deployment phase represents everything in the blue here. So once a company or an organization has capital, what assets should they buy with that capital, and what goods and services should they provide, and how should they think about placing it and pricing it, and then how can they manage expenses? To me, all of that falls under the heading of how we deploy our capital, but deploy and manage. Well, if you deploy and manage your capital effectively, then you should consistently have net income. If we have net income, then we get to this sort of distribution phase of finance, or that distribution phase of optimally allocating scarce financial resources. All we mean there is once you have excess cash and you feel like you don't need to plow back into the company anymore, or there might be reasons why you think it's better to actually distribute it back to financiers, then the question becomes in what form and how frequently and how much do we want to obligate ourselves in the future. So this gets into excess income distribution. So how do we get it back to the financiers? Drilling down just a little bit more on this definition, right, of finance is the study of the optimal allocation of scarce financial resources with these three subcategories of procurement, deployment, and distribution, hopefully helpfully labeled here on the virtuous cycle to make it a little bit clearer for us. But let's drill down on this concept just a little bit. So I told you that most of our time together was going to be focused on this second category of capital deployment. It's the biggest one, arguably involves the most decisions. So for me, there's also three subcategories underneath this broad heading. So when we think about capital deployment, one heading is operational efficiency. Another one is what I call go and no go decisions. And then the third one is asset purchases and sales. Operational efficiency, we're not going to talk too much about. This is where you get into ratio analysis and making sure that you're managing inventory and managing receivables and managing payables effectively. It's interesting, it's important, but I've discovered that typically managerial accounting classes, and especially our managerial accounting class, does an outstanding job of giving you exposure to operational efficiency. So I don't feel like we need to spend a ton of time on that. So what we're going to focus on instead is go, no go decisions and asset purchases and sales. Just as a couple of examples, and this can be on a really big scale or it can be on a very micro personal scale. On a big scale, one example here would be Tesla, in the last couple of years announced that they're going to create this Cybertruck, and they've even had prototypes and they've taken it to some of these auto shows. So that's an example of a go, no go decision. Tesla already exists. It already has assets. It already has core competencies. It already has manufacturing capabilities. It already has customers. It already has distribution channels. It already has supply chains. That stuff's all in place. What it was contemplating there with the Cybertruck is, should we create this new good? Should we step into this new market that we have heretofore not at all tried to compete in, specifically the truck market? And obviously, they've made the decision that they're going to compete, but that's an example of a go, no go decision. It's basically, should we do this or should we not do this? On a more micro level, one of the examples that we will keep coming back to over the course of our time together is about 5 years ago, my wife and I seriously contemplated putting solar panels on our roof and got a couple of bids ranging all the way from $26,000 to $31,000. And so that's a classic go, no go decision. Should we put solar panels on our house? Examples of asset purchases and sales. I'm based here in Provo, Utah. And so a transaction that took place here recently was that Qualtrics was purchased by SAP. If I'm not mistaken, the purchase price was $6 billion. It could be 8 billion. Sorry, I forgot. $6 or $8 billion. It was big. It was in the billions, multi-billion-dollar deal. It was big news here locally. And so that's an example of a company making an entire purchase of another existing company, right? So this isn't, should we put solar panels on our house or should we try to penetrate a new market with an existing set of assets? This is, should we just wholesale go and buy an entire company? And so we're going to spend time on both of these things, right? Go and no go decisions, and also asset purchases and sales. But really, these things share something in common, and a lot of the tools for making decisions in both of these settings are going to be the same. And I don't know if I've mentioned it yet. I hope that I have. Another way to think about finance is finance just tries to equip you with certain intellectual frameworks, certain thought processes, certain quantitative based decision tools to help you answer a simple question. And that question is it worth it? Whatever we're thinking about doing, is it worth it? Does it make financial sense? And again, what we're trying to do is create some apparatuses, some structures, some frameworks, some ways of approaching that question. And then again, we want to put in the tool belt some quantitatively based decision metrics to help you feel really confident about your approach, right? Your process of making a decision to answer that question of is it worth it? Well, it turns out that whether you're looking at a go, no go decision or an asset purchase or sale, really what it boils down to is valuation. It's going to turn into a valuation exercise. Whether it's project valuation, for instance, what is the value of actually pursuing this Tesla Cybertruck? Or what is the value of putting solar panels on my home? That's project valuation. Or asset valuation. Is it worth it? Or what is the value of Qualtrics as we're thinking about buying and selling that entire company? This is relevant, by the way, this asset purchases and sales, relevant for anybody that's buying and selling stocks, buying and selling bonds. This is relevant in the private equity space. There's a lot of different places where this applies, but it really, whether it's go, no go, or asset purchases and sales, it's going to turn in to a valuation exercise. So we need to be real thoughtful about what it means to engage in project and asset valuation. And again, just trying to remind you some things that we've hopefully said before. When it comes to financial assets, stocks, bonds, even entire companies, when we think about the value of a financial asset, the simplest way to say it is that value is the sum of the present value of the expected future cash flows. And just to remind us of why that is, right? I mean, just at its core, the value of any asset should primarily be a function of the utility that it provides. What are the benefits, right? This is how we're going to price or value any asset. It doesn't matter if it's a car, a smartphone, blue jeans, a hamburger. We're going to value an asset based on the utility that it provides. But when we get into the space of financial assets, we realize pretty quickly that the only utility financial assets offer us is future cash flows. When we're talking about stocks and bonds and entire companies, right? It's not like a smartphone where you don't keep your calendar on it, you don't text people through it. It's not like a hamburger that you eat and it gives you calories. It's not like a car that gets you places. If you own a stock or a bond, and by the way, projects and asset purchases and sales all fall into this category. The only benefit that a financial asset gives you is future cash flows. And so that's why the right way to value an asset is the sum of the present value of expected future cash flows. But immediately the question becomes, well, what do we mean when we say cash flows? And that gets us to our topic for today. So bringing you back to the virtuous cycle, remember financiers provide capital, firm uses that to procure assets, and then they use the assets to produce the good or the service that then generates revenue that hopefully translates into net income. Some of that gets plowed back to procure more assets and more raw materials. Indeed, a lot of our profits do have to be plowed back, and that becomes retained income. But there is a portion of our net income, again, admittedly being super loose here and kind of talking about net income and cash flows in the same breath. And I know that's not precise, but just let it slide for now. Whatever cash flows we generate that we're not plowing back, those cash flows get distributed to our financiers, whether it's our equity holders or our creditors. Those things, those cash flows that get distributed to our equity shareholders and our creditors, those are known as free cash flows. And it is precisely these cash flows around which we're going to build our valuation models. So when I tell you that value is the sum of the present value of the expected future cash flows, and this is fundamentally the primary tool, the primary quantitatively based metric that we're going to use to inform our go and no-go decisions and to inform our asset purchases and sales. What I'm really saying is the tools that we create are primarily going to be built up and around free cash flows to the firm as the skeleton. So think of free cash flows to the firm as either the skeleton that we're going to put flesh and muscle around, or think of it as the foundation on which we're going to build. You pick whatever imagery works for you. But what we need to do during the rest of our discussion right now is figure out how exactly do you calculate free cash flows to the firm? I hope that visually this makes a ton of sense. It's like, yeah, our firm works really hard to produce cash flows, right? Because we get the right assets, we produce a good or a service, it generates revenue, we manage our expenses, we optimize our efficiency in terms of these 3 or 4 steps. So we're working really hard to generate cash. Yes, we get that some of that cash has to be plowed back. And I hope that intuitively it makes sense that, like, yeah, whatever cash flows aren't being plowed back, those are the cash flows that go to the financiers. And so those are the right cash flows around which to build our models, but we got to get technical about how to actually calculate it. So here is the basic equation for how we calculate free cash flows to the firm. And by the way, I'm going to work you through the math, and then I promise I'll give you a few examples. I'll try to be really cautious and methodical as I show you how to do this. But here's the basics. You take operating cash flows and you subtract out net capital spending and net working capital. Here's the way to think about it. These right here represent your operating cash flows, right? Once your revenue is translated into net income, that's your operating cash flows. Net capital spending and increases to net working capital, that's your plowback, right? If I'm buying more property, plant, and equipment, that's capital spending, plowback. If I'm buying more inventory, that's also plowback, but that's net working capital. So there's your basic formula. Operating cash flows minus net capital spending minus increases to net working capital. Now, how do we generally speaking calculate operating cash flows? Well, we're going to start with earnings before interest and taxes. We're going to add back depreciation. But when I say depreciation, what I really mean is any non-cash items. You know, in order to get to earnings before interest and taxes, there's a lot of non-cash items, mostly expenses. So what we need to do is add back non-cash expenses because, again, we're talking about cash flows, not income. And then we want to subtract out taxes. Again, I'm going to give you an example here in a second. And I also have a few questions that I know tend to pop up that I'll try to tackle in a few minutes as well. Net capital spending is easily calculated as ending net fixed assets minus beginning net fixed assets plus depreciation. Again, examples and explanation coming at you shortly. And then the increase in net working capital is very easy to calculate. It's ending net working capital minus beginning net working capital. Just as a reminder, net working capital is typically defined as current assets minus current liabilities. Current assets minus current liabilities is our typical definition for net working capital. Now, when we get deeper into valuation, we start learning stock valuation models, specifically when we do a discounted cash flows model. We're going to slightly change our definition of net working capital, but I don't want to confuse you now. I'm just priming the pump a little bit. Net working capital is current assets minus current liabilities. We're going to tweak that just a little bit down the road, but we'll wait until that day to do it. A lot of people will just shorthand and they'll take everything that I just showed you and they'll put it into a single formula. And the single formula is free cash flows to the firm equals EBIT times 1 minus the tax rate plus depreciation. But remember, depreciation is shorthand for non-cash items. So EBIT times 1 minus the tax rate, add back any non-cash items that are involved with EBIT, subtract out net capital spending, right? That's property, plant, equipment. Subtract out any increases in your net working capital. And remember, jointly, those two things represent your plowback. So it's basically operating cash flows minus plowback. Let me give you an example. Up here at the top is going to be our inputs. And by the way, this is a very watered down, distilled, simplified example, but it will help us. Just understand how to do this. So let's assume that EBIT is 1,014. I mean, you can imagine this is thousands or millions, but 1,014, depreciation is 500, taxes is 368. Using all of that, we can get our operating cash flows. Ending net fixed assets is 2194, beginning is 2261. If we take that difference and add depreciation, we're going to get our net capital spending. Then remember, ending current assets and ending current liabilities together, that'll be ending net working capital. So the difference there will be ending net working capital. We'll take the difference at the beginning to get the beginning net working capital, and whatever the difference is there, that's going to be the increase. So if we throw it all into the table, there's our EBIT, 1014. We add back depreciation. I want to keep reminding you what that really represents is all non-cash items. And then we'll subtract out our taxes. So we get operating cash flows of 1,146. Again, this could be thousands, could be millions. Net capital spending is going to be ending net fixed assets minus beginning net fixed assets. And then we got to add back in this depreciation, and that gets us to net capital spending. Net working capital, we're going to take ending net working capital minus beginning net working capital. That will capture the increase in net working capital. So I want to keep repeating this. Net capital spending and increases in net working capital, those both represent plowback. So we take our operating cash flows of 1146, subtract out our plowback of 433 and 382, and that gets us to free cash flows of 331. Now, that was a very simplified example. What I want to do at this point is preemptively address a few questions that I know pop up because I've been teaching this long enough. Okay, so here's exactly what you just saw. There's nothing new here. Here is the first question that usually pops up. So let's just tackle this preemptively. Why is depreciation added to calculate net capital spending? See, people get really worked up because they feel like, oh, wait a minute, like they say you're adding depreciation here and you're adding depreciation here, and that's double adding depreciation, and my head is starting to hurt and it doesn't make sense. So hopefully it makes sense why depreciation gets added here, because in order to get to EBIT, you took out depreciation expense. But depreciation expense is non-cash. And what we're trying to do is figure out free cash flows to the firm. So if you're starting with EBIT, you got to add back the non-cash items to get to cash flows. This one, for some reason, seems a little bit more mysterious to people. So let me try to give you an explanation on why we're adding back depreciation, right? So we're taking ending net fixed assets minus beginning net fixed assets and then adding depreciation to get to our net capital spending. So that's question number one. Why is depreciation added to calculate net capital spending? Let me try to explain this to you. I want you to imagine a firm starts with 10 million in net fixed assets. During the year, it buys $1 million worth of new assets, and it also has depreciation expense for the year 500K. Let's just talk about basic accounting for a second. Do we all agree we're starting with 10 million in net fixed assets? We're adding 1 million of capital expenditures. We're depreciating out $500,000. So basic accounting 101 says that my ending net fixed assets is $10.5 million. I hope that's not mysterious. I know you've had your basic accounting class, so that ought to make sense to all of us. Well, let's make a few important points here as it pertains to the topic at hand. We know that the capital expenditures are $1 million. That was a given. Like, we know that with certainty. The question is, how can we calculate that? And the answer is ending net fixed assets minus beginning net fixed assets plus depreciation actually gets you to the answer. So let me prove this to you. If we start with ending net fixed assets, subtract out beginning net fixed assets, add back depreciation, what you will see is that we get that $1 million of capital expenditures. So I'm just trying to show you that's the reason why we add back depreciation when we take ending net fixed assets minus beginning net fixed assets. That actually gets us to the right number. It gets us to net capital spending. Okay, question number one, boom, check mark, got it. Question number two, why do we start with earnings before interest and taxes rather than earnings before taxes? I hope you can see that the difference there is interest. So what we're arguing is that in order to get operating cash flows, you should start with earnings before interest and taxes, not earnings before taxes. Why is that? The answer is interest should not be deducted when calculating operating cash flows. And I know that might be puzzling. You might be sitting there saying that doesn't make sense to me. Let me try to help you understand why this is the case. Interest should not be deducted when calculating operating cash flows. Remember, we said that this is the basis right here, right? We're back to this virtuous cycle that again, just as a reminder, helps us understand the three main categories of finance: procurement, deployment, distribution, right? Again, it's the study of the optimal allocation of scarce financial resources, trying to answer that age-old question of, is it worth it? Well, remember what we said is, as we go through this virtuous cycle, we get to this point where we have net income. Some of it gets plowed back in the form of capital spending or increasing our net working capital. Whatever doesn't get plowed back, we call that free cash flows to the firm. So any money that gets distributed to our financiers, that qualifies as free cash flows to the firm, and we want to capture that. Well, understand that this free cash flows to the firm that we're building our valuation models around, this represents all cash paid to our financiers. So who are our financiers? Shareholders, creditors. What are the main ways that we give cash to our shareholders and our creditors? Dividends and repurchases for our shareholders, principal and interest for our creditors. So all of those things combined represent free cash flows to the firm. See, the problem is, if you start with a net income that has been reduced by interest, then you've lost one of your main streams of free cash flows to the firm. You can think of right here, I should have created a graphic for this. There are four main rivers or four main branches or tributaries that give back net income to financiers. Those four main tributaries are dividends, repurchases, principal, and interest. But and we're trying to calculate this. We're trying to capture all that. But if you start calculating free cash flows to the firm using a net income that has been reduced by interest, you've immediately washed out one of those tributaries. You've immediately ignored one of the tributaries. So in order to preserve the four tributaries, we have to start with an income. We have to start with an income that hasn't taken out the tributary. So the way to start with that income is earnings before interest and taxes. Earnings before interest and taxes keeps interest in there, which again is one of those main tributaries, getting cash flows back to our financiers. Which, by the way, it shouldn't surprise you that there are actually two ways to calculate free cash flows to the firm. So we've been focusing on this top method of calculating free cash flows to the firm, operating cash flows minus net capital spending minus increases to net working capital, or stated alternatively, operating cash flows minus plowback. But the other way to get there is to just add up cash flow to creditors and cash flow to shareholders. In other words, just add up the four tributaries, right? Add up any debt pay down and interest payments. There's your creditors. Those are the two tributaries to the creditors. And add up stock repurchases and dividends. Those are the two tributaries to the shareholders. So, this is what I showed you previously. This was the first method that I showed you, operating cash flows minus plowback. But there's an entirely different way to get to free cash flows to the firm, and that's by doing cash flow to creditors plus cash flow to shareholders. Now, just to give you an example, let me put numbers to this. So imagine that the ending long-term debt is 538, the beginning long-term debt is 581, and interest paid is 93. Imagine that ending common stock and APIC is 462. And beginning common stock and APIC is 372 and the dividends are 285. Again, another way to get to free cash flows to the firm is to just add up the four tributaries. For the creditors, it's debt pay down and interest. For the shareholders, it's stock buyback, stock repurchases, and dividends. So we can just do that, right? And you can see here that if we ended with 538 and we started with 581, then we paid down, what is that, $43? And we had $93 of interest. So we paid down $43 of debt. We had $93 of interest, if I'm doing my head math here correctly, which I may not be, but I think I am. Then that gets us to $136 of cash flow to creditors. Again, $43 of pay down of debt, $93 of interest. Now, on the cash flow to shareholders side, this is a little bit more interesting because we actually didn't buy back stock, we issued stock. You can see this because our common stock and APIC is going up. So we actually don't have a stock buyback. We have a stock issuance, which that represents cash going the other direction. So cash flow to shareholders is actually the $90 we took away from them netted against the $285 in dividends. So that's a net of $195 that we paid to shareholders. Well, when you add up all four of the tributaries, total free cash flows to the firm is 331. It's just another way to get there, but I'm mainly trying to help you understand. I'm trying to help you understand why it is that we start with EBIT rather than earnings before taxes. It's because we want to keep interest in there, because interest is one of the tributaries to our financiers. Okay, question number 3 that usually pops up. Should taxes be calculated using EBIT or earnings before taxes? And you might guess that taxes should be calculated using earnings before interest and taxes, not earnings before taxes. So the way we're going to calculate taxes is taxes are earnings before interest and taxes times the effective tax rate. Again, that might make your head hurt. On this one, unfortunately, I'm going to have to ask for your patience. We're going to unlock the answer to this question when we get to our discussion on weighted average cost of capital, actually near the end of the semester. So for now, please just put that in your minds, that back here, when we say operating cash flows is EBIT plus depreciation minus taxes, the taxes should actually be calculated using EBIT, not earnings before taxes. So please just remember that, and I promise later in the semester I will try to explain to you why that is. Okay, last little section and segment that we need to cover here for the topic today. I want to try to do a little bit of a reconciliation between free cash flows to the firm and the GAAP statement of cash flows. So in your financial accounting class, you should have spent a fair amount of time learning about how to build a cash flow statement under generally accepted accounting principles. Turns out free cash flows to the firm doesn't get perfectly and precisely revealed on the cash flow statement, but you can reconcile it and it's not too hard. So I want to remind you, here's where we started with with free cash flows to the firm. Again, operating cash flows minus plowback. But I also told you most people just simplify it into this formula. And probably moving forward, you're just going to see me use this equation as well. So it's EBIT times 1 minus the tax rate plus depreciation. Again, that just means all non-cash items that are already built into EBIT. And then subtract out net capital spending and increases to net working capital. Okay, I want to drill down on this for just a little bit, because this equation, and let me just shuffle it around a little bit here. This equation is going to help us reconcile our calculation of free cash flows to the firm to the GAAP cash flow statement of cash flows. Turns out that EBIT times 1 minus the tax rate plus non-cash items minus increases to net working capital, if you put those three things together, that's really close to the cash flow from operations on a GAAP constructed statement of cash flows. You're almost there. Let me try to show you what I mean. So I just went and grabbed Netflix 10K for the last year. This is their statement of cash flows for the year ended December 31st, 2019. And let me just show you how this works here. So as we try to reconcile this, and by the way, this is only the operating cash flows section of the cash flow statement. Remember, there's also investing cash flows and financing cash flows. I'm only showing you operating cash flows. But notice, this cash flow statement, almost all cash flow statements use the indirect method, which I'm sure you talked about in your financial accounting class. This thing starts with net income. That is very close to EBIT times 1 minus the tax rate, almost. But the next section is adjustments to reconcile net income to net cash used in operating activities. These are all of the non-cash gains and losses that went into calculating net income. So the cash flow statement unwinds all that. Great. That's exactly what we want. Remember, we want EBIT times 1 minus the tax rate, and then we want to do non-cash adjustments. That's exactly what the cash flow statement does. So that's brilliant. That's beautiful. Then notice changes in operating assets and liabilities. Operating assets and liabilities are current assets and current liabilities. In other words, the next thing that a GAAP statement of cash flows does is it adjusts for any changes to net working capital. Specifically, let's say that inventory goes up or accounts payable go down. Those would be deltas in net working capital. The cash flow statement adjusts for that. So we're really close. Like the only thing that's not perfect is net income is not exactly where we want to start. So let's talk about how to reconcile this. It's actually just really easy. So I just showed you that GAAP statements of cash flows start with earnings before taxes times 1 minus the tax rate. They start with net income. But the right place to start is, for us, is EBIT times 1 minus the tax rate. Well, the nice thing is there's another way to write this. You could represent EBIT times 1 minus the tax rate as earnings before taxes times 1 minus the tax rate plus interest times 1 minus the tax rate. Since that's the case, it's really easy to fix the GAAP version. Fixing the GAAP version is as easy as taking what they start with. So they start with earnings before taxes times 1 minus the tax rate. Then we just add interest times 1 minus the tax rate. And that actually gets us right back to where we want to be, which is EBIT times 1 minus the tax rate. Now, for me, that's easy, but let me put some numbers to it, because if you're not in the accounting world and if you haven't spent much time in accounting, this actually might be a little bit baffling. Let me try to show this to you. Assume earnings before taxes is 10 million. Interest is 1 million. So that means that earnings before interest and taxes are 11 million. And then let's assume a tax rate of 21%. Okay, let's start right here. So earnings before taxes times 1 minus the tax rate, that would be 10 million times 1 minus our tax rate. That is 7.9 million. So GAAP statements of cash flows would start with that number. They would start with net income of 7.9 million. But the right place to start for us is actually EBIT, 11 million times 1 minus the tax rate, which is 8.69 million. But again, there's another way to write that. We can write this as 10 million times 1 minus 21% plus 1 million times 1 minus 21%, and we still get the same answer. So the way that we fix the GAAP version is we just start with their starting point, right? Their starting point is 7.9 million, which is 10 million times 1 minus 21%. And then we just add on interest times 1 minus the tax rate. And that gets us exactly to where we want to be. So again, it's super easy to fix the GAAP version of operating cash flows. Just add interest times 1 minus the tax rate. Let me try to show you this. I'm back to Netflix here, right? So remember, they're going to start with net income. The way to fix that is pretty easy, right? We're going to take their earnings before taxes times 1 minus the tax rate. We're going to add interest times 1 minus the tax rate. So we start with GAAP operating cash flows, which is right here. They actually have negative operating cash flows because they're buying so many streaming they're buying so much streaming content. So they actually have, and this is in thousands, so they have minus 2.87, let's just call it minus $2.9 billion of operating cash flows. What we need to do is add interest times 1 minus the tax rate. So if you go into the footnotes, you can find that. You can see actually lower down on the cash flow statement, it's going to show you interest. So it's 599 million. So we're going to grab that. And then there's a footnote on taxes. You can see that their effective rate in 2019 was 9%. So we're going to take 599 million times 1 minus 9%, make that adjustment. And we now have the corrected operating cash flows of minus 2.33 billion. Okay, so that represents those three elements of free cash flows to the firm, right? Free cash flows to the firm is EBIT times 1 minus taxes, add back the non-cash items, subtract out increases to net working capital. All three of those are captured by what we just did back here, right? That is the minus 2.3 billion. So let's put that in. Now the last thing that we need is net capital spending. Well, we can go and get that from cash flows from investing activities. You can see purchases of property, plant, and equipment. They're also spending money on other assets. So they're using 387 million in terms of net capital spending. So that's easy. We put that in, right? So we have our minus 2.3 billion that we calculated earlier, subtract out the 387 million that's net capital spending. And that means free cash flows to the firm actually represents negative 2.7 billion. Now, that's not very typical. Normally, firms would have positive free cash flows to the firm, but let me show you one last piece of the puzzle. Netflix is burning a lot of money right now, and this shows you what's happening. So free cash flows to the firm is minus 2.7 billion, but what's happening is they're issuing a lot of debt. You can see in 2019, they issued $4.5 billion of debt. So they're actually not giving money to financiers. They're in money collection mode right now. So they're still bringing in a lot of money from financiers. So, okay, let me just remind you at the end here why this is so important. So we talked about how to calculate free cash flows to the firm. The basics is operating cash flows minus plowback. To be a little bit more specific, that's EBIT times 1 minus the tax rate, add back any non-cash items, subtract out plowback in the form of net capital spending and increases to net working capital. Why do we need this? Because that literally represents the excess cash after the firm works so hard to create their product and deliver their service and manage their expenses. That's the excess cash that's been generated after the necessary plowback. So that is visually, intuitively the right cash flow for financiers to build a valuation model around. Why is that? Valuation is the sum of the present value of the expected future cash flows. Why? Because value is always a function of the benefits, and the benefits that financial assets provide are cash flows. What specific cash flows? It's these. These are the cash flows that come back around to the financiers. So that's literally the utility. That's the benefit. That's what they get out of it. So those are the right cash flows on which to build our valuation model, which is going to be really important because, again, we're worried about go, no-go decisions. We're worried about asset purchases and sales. Fundamentally, it's going to come down to valuation as we try to answer the question, is it worth it? It's going to be a valuation exercise. The value is going to be the sum of the present value of the expected future cash flows. And we now know that the cash flows we're talking about, generally speaking, are going to be free cash flows to the firm. All right, that's it for now. I hope this has been helpful. We'll talk to you later.